When we hear the words artificial intelligence, what instantly pops into your head? Probably lines of code, right? Or maybe virtual assistants, or some crazy generated art popping up on your screen. But listen, there is a massive, quiet revolution happening right now, far away from your web browser, and it's actually being led by a century-old industrial giant. Today, we are doing a deep dive into how Hitachi is rapidly transforming from a very traditional manufacturing conglomerate into an absolute AI powerhouse. Okay, let's dive into this explainer. To really grasp the scale of what we're talking about here, we need to draw a hard line between digital AI and physical AI. Digital AI, your chatbots, your generative algorithms, coding assistants, that's what absolutely dominates the headlines right now. It's ethereal, it lives in the cloud, and yeah, it's undeniably transformative. But physical AI, that's the application of artificial intelligence to the actual tangible world we live in. We are talking about the physical trains that move millions of commuters every single day, the smart energy grids that keep our megacities running, and the massive factory floors manufacturing the goods we rely on. The hype is all digital for sure, but the high-impact, high-stakes reality, that is incredibly physical.
Here's our roadmap for today. 1. Beyond chatbots, physical AI. 2. Building the AI ecosystem. 3. Financial reality and valuation. 4. The bull and bear case. And 5. Actionable investment insight.
Section 1. Beyond chatbots, physical AI.
Think of physical AI as the bridge connecting software and heavy machinery. Now, you might be wondering, why Hitachi? Why not just hand this over to a pure tech company? Well, because tech companies know software inside and out, but they don't know the physical world the way a company with over 100 years of industrial heritage does. Hitachi possesses the actual operational technology, the raw physical assets required to actually make this leap. They aren't just writing code in a vacuum. They're writing code for machines they have literally spent a century perfecting.
Moving on to Section 2. Building the AI ecosystem.
The sheer scale of their ambition here is wild. Just look at the players involved. In June, they announced a massive collaboration with Intel, essentially combining Hitachi's operational tech with Intel's computing muscle, specifically targeting factory automation. And then, look at their software stack. They've partnered with OpenAI to integrate codecs for legacy modernization, while simultaneously teaming up with Anthropic to weave the Claude AI model directly into their flagship Lumada 3.0 platform. Add Google Cloud and NVIDIA to scale up their infrastructure and, well, what you're looking at isn't just some standard list of vendors. Hitachi is effectively building the operating system for industrial AI.
Now, what's really interesting about this is the human element behind all this technological shift. Hitachi has a goal to cultivate 100,000 AI professionals internally. Let's put that into perspective for a second. They have a total workforce of roughly 290,000 employees. That means they're aggressively upskilling over a third of their entire global workforce. They aren't just throwing money at AI software, they are literally rewiring their corporate DNA from the inside out to make sure their people can actually deploy these tools at scale.
And all of this culminates into an absolutely enormous competitive advantage known as being customer zero. Because Hitachi already owns the factories, the data, and the hardware, they can build an AI solution for, say, a power grid, test it on their own actual assets to work out all the bugs, and then turn around and sell a proven, battle-tested product to the wider market. Pure software companies, they simply cannot replicate this. It creates an incredibly deep economic moat around Hitachi's business.
Let's move to Section 3, Financial Reality and Valuation.
Okay, let's look at the hard numbers, starting from the top down. For the fiscal year ending March 2026, Hitachi has projected full-year sales of 10.58 trillion yen, backed by over 800 billion yen in net income. And they're already proving they have the momentum to get there. In their first quarter, they reported a massive 20% year-on-year jump in revenue. The foundation here is incredibly solid.
Let's look under the hood for a minute. That 1.14 trillion yen figure? That is the revenue generated in just the first quarter of the fiscal year by Lumada, their high-margin digital business. This proves beyond a shadow of a doubt that their huge pivot, moving away from traditional, lower-margin hardware into high-margin digital services, is actually working.
Drilling down even further into the pure AI play, their specific AI suite, known as H-Max, brought in over 111 billion yen in that exact same quarter. This specific segment is the true growth engine of the company moving forward. They aren't just making promises about the future of AI. They are actively monetizing their AI ecosystem right now, today.
So what does Wall Street think of all this? Well, the stock currently trades at a premium price-to-earnings ratio of about 32. That means the market is already pricing in a good chunk of this AI transformation. But the analyst consensus is still a strong buy.
With the stock price hovering in that 5,200 to 5,700 yen range, major institutions, everyone from UBS down to JP Morgan, see a potential upside ranging from 14% to over 34%. Oh, and they're also actively buying back shares, which adds a really nice layer of structural support to that stock price.
Section 4. The bull and bear case.
Let's be totally objective and weigh the two sides here. The bull case is undeniably compelling. You have that massive customer zero moat we just discussed, an unmatched partner ecosystem spanning both hardware and software, and the promise of rapidly expanding profit margins as they scale that Lumada platform. Honestly, it's a textbook digital transformation. But we have to look at the bear case because the risks are real. Transforming a century-old industrial conglomerate into a nimble, AI-driven services company, that carries massive cultural and execution risks. Trying to seamlessly integrate cutting-edge AI with clunky legacy systems is incredibly difficult. Plus, that premium 32 PE valuation we mentioned means absolute perfection is basically priced in. Any macroeconomic weakness or a sudden slowdown in capital expenditure by their clients could trigger a sharp correction. At the end of the day, they are still tied to capital-intensive industries that are historically very vulnerable to economic cycles.
And finally, Section 5. Actionable Investment Insight.
If you take one single thing away from this explainer, make it this. Hitachi is not just a tech stock, it is an industrial stock that is successfully pivoting to high-margin digital services. They offer an incredibly fascinating risk-reward profile for the long-term observer. Why? Because they aren't just selling the hype of AI, they're actively integrating it into the steel, the power lines, and the rail networks that literally run the global economy. Their partnerships are verified, their digital revenue is absolutely surging, and they have an unassailable advantage in being able to test their own products before taking them to market.
As we wrap things up, I want to leave you with a thought to chew on. We spend so much time looking down, marveling at what AI can generate on our digital screens. But when you look at a massive pivot like Hitachi's and the literal billions of dollars in play, you really have to ask yourself, is the true world-changing future of AI going to stay neatly trapped in the cloud, or is it going to fundamentally rewrite the rules of the physical world all around us? Thanks for tuning in, and keep exploring.